day trading the next Fed meeting, we're going to give you a bunch of statistics around June's meeting, and then also some evergreen numbers for day trading most Fed events, or even non-farm payroll events, any binary event that might shake up markets. But I do want to focus on June's FOMC meeting. We're about a week out, and the chances of a 25 basis point hike now at about 38%. And a month ago, that was 9%. And a month before that, they were looking at 20, 30, 40% chance of an interest rate cut at this June meeting. So the odds shifting, and the closer that we are to 50-50 split, the more volatility you would expect, right? The less that is known going into an event, the more that whatever the outcome is likely to shake up the market. Usually we'll go into an FOMC event and it'll be 95% chance of a given outcome. They're going to do nothing, they're going to hike, they're going to cut, and then they inevitably do that thing that's been priced into the market, and the market doesn't shift that much. It has not been the case for recent meetings, which has brought about some great volatility and some great trading opportunity. Also, of course, with that, with every opportunity, there is a risk, and usually what traders will do to delineate, that potential opportunity and risk, delineate normal versus extreme price action, is they'll throw standard deviations on markets, daily returns. And so they can see, okay, we're going into the Fed meeting. Let's say it's Wednesday afternoon and the S&P 500 is around unchanged, or maybe it's up 0.5 percentage point, down 0.5 percentage point. If we see that market scream higher or lower by 1.5%, 2%, that's outside of one standard deviation. You can see that first dotted line, that's one standard deviation at right around 1.5%. So anything outside of that would be an extreme move, only occurring 32% of the time. You get outside of that second dotted line, closer to 2.5%, 3%. Now you have a move that occurs less than 5% of the time, 2 standard deviations. Standard deviations you can throw on any market to let you know what the average movement is. A standard deviation essentially takes all the data in a data set and then says, okay, most of the data is within this range. And then thus, if you have a movement outside of that range, that's an outlier. Traders usually find some opportunity in those outliers. It's, if you're day trading especially, but also if you're swing trading, trading options, it's usually easier to make money off of a market that is moving one way or the other, or moving a bunch and then settling down, or settled down and now moving a bunch, than it is to make money off of a market that's not moving at all. If you can find out how to do that, please let me know. And you might say, oh, well, you can sell options. Well, if the market doesn't move at all, those options are not going to be priced very high, so you're still not making money. So either way, volatility, usually synonymous with opportunity. And on these days like Fed meetings and the one that's coming up, we tend to see more volatility, and traders will tend to take these standard deviations and then throw a little extra juice on them depending on what the market is. And so, for example, if it's a big earnings day, then you might juice up the stock market by 2 times to say, oh, the stock market, that's going to really be moving on a day where Apple and Microsoft or whoever is reporting earnings. On a day that the Fed is changing interest rates, we're going to want to really juice up the interest rate market that we're trading. And so here you might go from a treasury bond market that moves, those at the top there are your, I think I crunched numbers for maybe the last year or so of trading, standard deviations around normal day, every day. The treasury bond market has a 1 standard deviation just under a percentage point. And on FOMC trading day, maybe I want to juice that by 2 times. And so I'm looking for a move that's outside of 1.5%, 2% in treasury bonds. Same to a diminished degree in currency. That would be my second tier mover. Go from trading anything outside of 0.6% to about 1%, a move outside of that range would maybe be intriguing to a day trader. And then stocks and gold being third and fourth tier movers respectively, I would only multiply that standard deviation by 1.5 or 1.25 times. So we're looking for S&P 500 moves outside of 2%, gold moves outside of 1.25 there. And your trading style is going to dictate what you would do with a move like that. For example, we talked about the S&P 500 here, and say now we're looking for a 2% move. So a little bit more than that one standard deviation. If the market falls by 2 to 2.5%, and I'm a contrarian day trader, then I might look to buy that market on its return to a more normal range. If I'm a trend follower and it slips by 1.5, 2%, I might sell that market looking to go with that trend lower. Obviously, when you wrap standard deviations around these things and you start to talk about, a 2.5% or 3% up or down move in the S&P 500 being relatively rare, and you're following that trend, keep in mind that, essentially selling at down 2.5%, you have not so great a case for that market moving down 3%, 4%, 5%, as that only happens, 1 or 2% of the time, very rarely, that is to say. So, of course, the decision around what you do with these big moves is up to you, but this is what professional day traders will tend to look at. When I was at the Board of Trade, we looked at these standard deviations on outright markets and pairs between them, interest rate pairs and different Forex pairs and stock pairs and everything else. And then when you'd see on an FOMC day or a non-farm payrolls day movement outside of those ranges, that's when things are really starting to move around, and you have some greater potential for day trading opportunity and, of course, risk. Those are some of the biggest moving days, and were some of also my biggest losers as well at the Board of Trade. So you got to always be mindful of that increased risk as well. And just as an example here, looking at the March 22 meeting, of what you're likely to get around the time of this announcement from the Fed. There I have circled the 1 p.m. Central Time, 2 p.m. Eastern. And you can see that these three markets that I've highlighted, bonds in black, Euro, USD in gray, and S&P 500 in red, real big jumps right around that. And you can see the S&P 500 rallies and then to highs on the day, and then falls not only back to unchanged, but to being down considerably on this March FOMC meeting. Bonds rally up right on the number, give back some ground right after the number, and then close the day through their highs on the session. Euro, similar story as both these markets, kind of splitting the difference. Big rally going into the number and then selling off a little bit after the number. And yeah, you're likely to see, of course, the Fed alters interest rates. So bonds or interest rate markets will be the most influenced, the first tier mover. Foreign exchange usually being the second tier, as interest rates have a huge effect on the carry trade and thus the supply and demand between US dollar and other markets. So if the Fed hikes interest rates 25 basis points, and I'm getting paid more in the Forex market to be long US dollars overnight, there'd likely be some greater demand for that US dollar relative to that euro, that Japanese yen, these other Forex, these other currencies where their central banks didn't hike rates. And then, of course, third tier mover being stocks, and fourth tier being commodities like your gold, and even crude oil can get some movement, but the rhyme or reason can be, fourth tier, fourth derivative at that point, so not very significant. But that's how you might look at in terms of tiers of movers and also standard deviations. I'll throw those up here to close. Day trading this FOMC meeting that's coming up, and also day trading those Fed meetings going into the future.